Ainslie News today, this Wednesday, 26th of August. Today we're talking FOMO. We all suffer from it from time to time, but we're talking FOMO versus valuation reality in the casino. If you are looking at the current share market and saying that it makes sense, however, that is not stopping people buying in at these levels purely on the thesis of momentum and central bank support. The herd is alive and well and playing the casino that is currently markets, somehow thinking their house has their back. On Monday, we discussed the real investment advice Lance Roberts' strongly held view that March was merely a correction and that the real end to this bull market, the longest in history, is still at large. In speaking to that bullish herd, he notes, price measures the current psychology of the herd and is the clearest representation of the behavioural dynamics of the living organism that we call the market. So one shouldn't underestimate the extent to which markets can get irrationally exuberant before reality takes over. At such times, FOMO can kick in and people pile in at the end. To contain that FOMO, you need to look at the fundamentals of what you're buying into. Buying shares should ultimately be based on the future value and returns of the company measured in any number of ways. Buying shares at this latter stage in the longest bull market in history should not be about seeking a yield in the absence of any other investment providing one, particularly when you are chasing a 4% yield against the potential of a 60% drop in your capital. Roberts reminds us of the effect of monetary stimulus on growth, as measured by share prices, and the cyclical trap it presents. Point 1. Using monetary policy to drag forward future consumption leaves a larger void in the future that must be continuously refilled. Point 2. Monetary policy does not create self-sustaining economic growth and therefore requires even larger amounts of monetary policy to maintain the same levels of activity. Point 3. The filling of the gap between fundamentals and reality leads to consumer contraction and ultimately a recession as economic activity recedes. Point 4. Job losses rise, wealth effect diminishes, and real wealth is destroyed. Point 5. The middle class shrinks further. Point 6. Central banks act to provide more liquidity to offset recessionary drag and restart economic growth by dragging forward future consumption. Point 7. Wash, rinse, and repeat. Okay, if you don't believe me or believe Roberts, here's some evidence to point that forward. The stock market has returned more than 130% since the 2007 peak, which is more than 12 times the growth in corporate sales and 3.6 times more than the GDP. Check out this next chart here, showing the markets disconnected from the economy. He then goes on to share a few different valuation methods to show where we are right now. Firstly, Tobin's Q ratio, which measures the market value of a company's assets divided by its replacement costs. The higher the ratio, the lower the future returns. This next graph adds in the better-known Shiller KEPE10 ratio, highlighting the strong correlation between the two and the historically proven outcome of low 10-year returns from such heady highs as we currently find ourselves. This next chart here, might need to zoom in on that one a little bit, but it goes all the way back to 1904 so that we can see those cycles more clearly, all the way up to 2019. Removing the this time is different because rates are so low and promise to be so for some time, he adjusts the Shiller KEP10 accordingly. So this is KEP10 adjusted for rates versus the 10-year forward returns. But sales are so strong. No, they're not really, are they? Measured against sales, valuations are pushing their highest level in history. So all of these valuations are being based on no sales. Warren Buffett, who last quarter made a big move into gold and out of financials, has a favourite measure of value, being market cap divided by GDP. Again, pushing record highs. This next graph here showing the Buffett indicator versus 10-year forward returns. Big money, smart money, is still piling into gold and silver as seen in this next chart as well. This may be a hedge while still playing this rigged casino, or they may just be handing it over to the hapless retail investors to again come in at the end. Only time will tell, but history says it generally doesn't end well. And for the mums and dads just looking for that 4 to 5% yield, they are yet again forgetting the math that says after a 60% drop, you'll need to make 150% back to get even or where you started from. Check out these charts here next shown to finish up with. Weekly transparent gold holdings. Look at that massive growth there towards the end of 2019 and continuing on into 2020, of course. And silver as well. While we did have a very steep rise there, it did kind of plateau out a little bit here as we have a brief rest there at the top. Well, guys, that's news for today. You can always go to ainslieBullion.com.au to see all things gold and silver. We, of course, had some very special picks used yesterday. We only had 600 of them. They're already sold out. So someone or some people have snapped up those coins very, very quickly, of course. Go over to ainsleewealth.com.au for all of our cryptocurrency products. And check out our gold and silver back token on goldsilverstandard.com. Thanks for joining us. We'll catch you again tomorrow.